There are 4 essential criteria that must be considered before executing such continuation trades. The first rule requires the price to form a change of character pattern or flip pattern after reaching the higher time frame supply or demand zone. Secondly, we must patiently await a break of structure and a zone breakout in the price movement. The third rule emphasizes that the price should have left inefficiency behind when forming a break of structure. The last and most crucial rule is the presence of static liquidity zones near our identified point of interest. In summary, to have an opportunity to execute continuation trades, it's essential that all of these rules and criteria are met, and there are no exceptions. Here, all the mentioned criteria are met. Next, we place our sell limit order at the lowest point of the supply zone, with the stop loss a few pips above the highest point of the area. For the take profit, we have the option to target the unmitigated demand zone on the higher time frame like 15 minutes or 1 hour, or the swing low of the current time frame. In the following, we can see that the price once again has created a new break of structure and has already broken through the next demand zone, leaving inefficiency behind. Thus, we have another unmitigated supply zone on the 1-minute time frame. Additionally, we can see that the price formed a bearish trendline liquidity below our newly identified supply zone. In this scenario, the price will likely push back up to clear the liquidity above the trendline, triggering the stop losses of retail traders. It aims to fill the inefficiency left behind and then tap into the supply zone situated at the extreme. With all the criteria of the continuation entry model met, we can now place our sell limit order at the highest point of the order block and set the 15-minute time frame swing low as our take profit target. To execute multiple trades simultaneously, some certain points and rules must be considered to reduce risk exposure. Limit the number of open positions to a maximum of 3 at the same time. Always remember that the position size you risk for the first entry should be halved for the next upcoming trades. For example, if your first position size is 2 lots, it's advisable to risk half that amount, which is 1 lot, for the subsequent trades. Now let's proceed to the real chart and see trade examples. Here, we have the euro-dollar 4-hour time frame on the screen. The market's overall direction is bullish. We see that the price, after sweeping the sell-side liquidity accumulated below the equal lows, and then drastically pushed to the upside. It has broken through the latest major high and also created a bullish break of structure with great inefficiency. Continuing, we see that the price subsides its bullish momentum, and after a temporary pause, reverses its direction to the downside. We see that the price has taken out the inducement level by breaking below this candle's low, which represents the most recent internal pullback that the price formed on its upward path. Since the inducement has been taken out, that confirms these low and high as valid major structures, and subsequently, we have a valid break of structure right here. Now, since we have a valid bullish break of structure, we are now allowed to identify an order block or demand zone attributed to the recent valid BOS. As we can see in the following, the price has retraced back down, entered a pullback phase, filled the inefficiency left behind, and reached our identified demand zone. Here, we anticipate the price to react and get reversed. Since the price has tapped into the 4-hour time frame, our next step is to zoom into the lower time frame, in this case the 15-minute time frame. This allows us to gain a clearer view of the price action and search for any signs of a change of character pattern in market behavior.
If you're interested in automating your trades through the help of our advanced automated trading system and gaining over 70% to 83% daily, be sure to DM me on TikTok or Instagram for step-by-step guide on how to get started.
Here, on the 15-minute time frame, we see that the price was in a downtrend until it reached the 4-hour time frame's demand zone. After reaching this zone, the price reversed, moved to the upside, broke the 2 successive structures, and left a great inefficiency behind. So, a crucial question arises. Does this change of character provide a high probability, or does it carry a high chance of winning if we use it to execute trades? We have fully discussed the rules and criteria that need to be considered to identify a high-quality change of character in previous episodes. As you know, guys, a change of character is valid only under one condition, price reverse and originates from a higher timeframe supply or demand zone before breaking the recent major structure and initiating the change of character. So here we see that price has done that. Secondly, for having a high-quality change of character which provides a high probability in the market, price must sweep static liquidity zones before tapping into the identified supply or demand zone. Here we can see that price has swept the liquidity below these equal lows and then continued to its bearish movement. The third criteria for a change of character pattern to be more effective with a higher chance of success is that the price should break and close below or above the two successive structures or zones along its path. Once again, we see that price has broken out two successive structures after mitigation of the 4-hour timeframe's demand zone. So guys, all the criteria needed to confirm a change of character as an effective one have been met here. Following the formation of the change of character pattern, in the next step, we identify and highlight the demand zone generated by the change of character's bullish wave on the 15-minute time frame. Next, we need to zoom into the 1-minute time frame